My name is Manjiri Manerkar and I am going to present on the topic classification of budgetary control on the basis of functions. First, let us know the meaning of budgetary control. Budgetary control is the financial jargon for managing income and expenditure. In practice, it means regularly comparing actual income or expenditure to planned income or expenditure to identify whether or not corrective action is required. It is the process by which budgets are prepared for the future period and are compared with the actual performances for finding out variances, if any. The comparison of budgeted figures with the actual figures will help the management to find out variances and take corrective actions without any delay. The budget is classified into three types, that is classification according to time, classification on the basis of functions, and classification on the basis of flexibility. Under the classification according to time, it is again classified into three types of budgets. They are long-term budget, short-term budget, and current budget. Then the classification on the basis of functions include operating budget, financial budget, and master budget. And under the classification on the basis of flexibility, they are of two types, a fixed budget and flexible budget. Now, we will briefly study the classification of budget on the basis of functions, which is further classified into three types as I said earlier. They are operating budget, financial budget, and master budget. Under operating budget, there are sales budget, production cost budget, purchase budget, raw material budget, labor budget, plant utilization budget, manufacturing expenses budget, administrative and selling expenses budget. Then the second one is the financial budget, which is further classified as cash budget, working capital budget, capital expenditure budget, income statement budget, statement of retained earning budget, and budgeted balance sheet. And the third one is a master budget. Now, under operating, now under operating budget, we will mainly focus on three budgets, that is plant utilization budget, uh, works overhead budget or works overhead budget or manufacturing expenses budget, and administrative and selling expenses budget. Now, plant utilization budget forecasts the plant and machinery requirement to meet the production budget. Plant utilization budget is prepared in terms of working hours, weight, or other convenient units of plant facilities required to carry out the program laid down in the production budget. The objective of the plant utilization budget is to determine the load on each process, cost, or group of machines for the budget period, to indicate the process or cost centers which are overloaded so that corrective action can be taken, to dovetail the sales production budgets where it is not possible to increase the capacity of any of the overloaded processes, and to make efforts to boost sales to utilize the surplus capacity. The second one is the manufacturing expenses budget or works overhead budget. The manufacturing overhead budget consists of all the cost rather than raw material and labor that will be incurred by manufacturing company or department during the fiscal year. These ongoing costs are a valid part of manufacturing expenses that incur and should be calculated as a part of manufacturing budget. In business, overhead expenses refer to an ongoing expenses of operating business. Overheads are the expenditure which cannot be conveniently traced to or identified with any particular cost unit, unlike, unlike operating expenses such as raw material and labor. Therefore, overheads cannot be immediately associated with the products or services being offered, thus, do not directly generate profits. However, overheads are still vital to business operations as they provide critical support for the business to carry out profit making activities. For example, Overheads costs such as the rent for the factory allows workers to manufacture products which can then be sold for profits. How overhead expenses are all cost on the income statement except the direct labor and direct materials and direct expenses. Overhead expenses include accounting for fees, advertising, insurance, interest, legal fees, labor burden, rent, repairs, taxes, travel expenditures, etc. Now, the third one is the administrative and the selling expenses budget. Selling and administrative expenses budget is a schedule of planned operating expenses other than manufacturing cost. It is a component of master budget and is prepared by all types of businesses before the preparation of budgeted income statement. Usually, it is divided in two sections: the selling expenses and the administrative expenses. Both selling expenses and administrative expenses may be fixed or variable. For example, sales commission and freight cost on the sales are variable selling expenses, whereas sales salaries are fixed selling expenses. Similarly, depreciation on rent or office building are fixed administrative expenses, whereas office supplies and utilities expenses are variable administrative expenses. Different variable and different variable selling and administrative expenses vary with different types of activities. For example, sales commission vary with the number of units sold, entertainment expenses with number of employees in the organization, etc. Therefore, an accurate selling and administrative expenses budget can be made by using activity based costing. Now, the second one under the classification of budget on the basis of function is the financial budget. A financial budget is a budget in a financial budget in budgeting means predicting the income and expenses of the businesses on the long term and short term basis. Accurate projection of cash flow help the business to achieve its target in the right way. Financial budget preparation includes a detailed budget balance sheet, cash flow budget, the sources of income and expenses of the business, etc. The evaluation of income and expenses is done on monthly, quarterly, half yearly, or annual basis, depending on the suitability of the organization. The financial budget is a very powerful tool to achieve the long-term goals of any business. Importantly, it also keeps the shareholders and other members of the organization updated about the functioning of the business. The commonly used financial budgets are cash budget, working capital budget, capital expenditure budget, income statement budget, statement of retained earnings budget, budgeted balance sheet, or position balance sheet. Now, the third one is the master budget. A master budget is a summary of all the functional budget. It is defined as the summary budget, incorporating its component functioning budget, which is finally approved, adopted, and employed. When the master budget is complete, its details shall be considered by the budget committee, and if approved, it will be submitted to the board of directors. However, once it is finally approved, it becomes the target of the organization during the budget period. The master budget is usually prepared in the form of budgeted profit and loss statement. It begins with the sales budget figures, from which production cost budget figures and overheads are deducted in order to arrive at the figure of budgeted profits. Thank you.